Here's what separates the people who get obscenely wealthy from market crashes from the people who lose their entire life savings. It's not luck. It's not secret knowledge. It's pattern recognition. In 1929, when Joseph Kennedy recognized the market had become detached from reality, he made 3 specific trades in sequence. 6 months later, the market collapsed 89%, and Kennedy walked away with $50 million, while ordinary people lost everything. Fast forward to 1987. Paul Tudor Jones identified the same warning signs, executed the same 3 trades, and when October 19th arrived, the day markets fell 22.6% in a single trading session. Jones made $100 million in that single day alone. His fund was up 62% just in that month. Then 2008 hit. Michael Burry, John Paulson, and a small group of other investors who saw it coming made those exact 3 trades again. Burry profited over $700 million. Paulson turned $50 million in premiums into $15 billion in payouts, personally netting $4 billion. And right now, in 2025, Warren Buffett is sitting on $325 billion in cash, an all-time record in corporate history. Ray Dalio is publicly discussing gold holdings. Bill Amann has hinted at positioning similar to his March 2020 trade that turned $27 million into $2.6 billion in weeks. These aren't different people using different strategies. They're the same pattern repeating. Not 4 trades, not 5 trades, not 10 different strategies tailored to each unique market environment. 3. The exact same 3 trades that have worked before every major financial collapse in the last 100 years. This matters because it means crashes aren't random events. They're not unpredictable chaos. They're mechanical sequences. And if you understand the sequence, you can see it coming before the majority of people even realize what's happening. Here's why this pattern works. Every crash follows the same progression. It doesn't matter whether we're talking about 1929, 1987, 2008, or right now. The sequence is identical. It begins with extreme valuations. Asset prices completely disconnect from the underlying reality of what those assets are actually worth. In 1929, stocks were trading at multiples that had no basis in earnings. In 1987, the Dow had tripled in 5 years, while fundamentals stayed flat. In 2008, housing prices doubled in 5 years based on lending standards so fraudulent that even the originators knew the loans would fail. In 2025, the Buffett indicator, which measures total stock market value against GDP, sits at 185%. That means stocks are valued at almost twice the entire economic output of the country. These are historic extremes. Then comes the second phase, excessive leverage. When prices are rising, and everyone believes they'll keep rising forever, people borrow heavily to amplify their gains. In 1929, retail investors were borrowing 90% of stock prices on margin. In 1987, portfolio insurance and program trading created synthetic leverage throughout the system. In 2008, the entire financial system was built on derivatives and mortgages leveraged 50-1. In 2025, margin debt is approaching all-time highs. The system is saturated with borrowed money. This is the moment that sets the trap. The leverage feels safe because prices are rising. But it's a trap because it removes all cushion. One small decline triggers a cascade. The third phase is a triggering event. Something causes a modest decline. It could be rising interest rates. It could be a fraud discovery. It could be unexpected policy changes. It could be geopolitical shock. In 1929, it was the Hatry fraud scandal in London. In 1987, it was rising rates and a program trading glitch. In 2008, it was subprime defaults accelerating faster than anyone predicted. In 2025, it could be commercial real estate defaults cascading through the system, or a major bank failure, or a geopolitical incident that creates sudden fear. The specific trigger doesn't matter. What matters is what it triggers next. Because here's where the mechanical part becomes inescapable. When leveraged investors face losses, brokers issue margin calls. These investors are forced to sell. That selling drives prices lower. Lower prices mean more investors hit margin requirements. They're forced to sell too. More selling equals lower prices, triggering even more forced selling. This creates a death spiral. It's not a gradual decline. It's a liquidation cascade where the selling accelerates because of mechanics, not because the fundamentals got worse. Then comes panic. Fear overwrites all rational analysis. Investors don't ask whether this is a good buying opportunity. They ask whether they'll lose everything. Liquidity evaporates. The bid-ask spreads blow up. Prices gap down violently. The VIX, the volatility index, spikes into territory that looks apocalyptic. Markets fall 20%, then 30%, then 40% in weeks. This is why the same three trades work every single time. The trades aren't designed to beat a random market. They're designed to protect you through each specific phase of this mechanical sequence. Trade 1 addresses the recognition phase. You see the unsustainable valuations. Understand that risk now exceeds potential reward, and you exit. You convert your stock positions to cash and preserve your capital before the crash even happens. Trade 2 addresses the wealth preservation phase. While sitting in cash, you're exposed to currency risk. Central banks will print money to bail out the system. That printing devalues the currency. So you hold hard assets, specifically gold, that maintain purchasing power when paper currencies collapse. Trade 3 addresses the profit phase. You don't just survive the crash protected in cash. You actually profit from it. This requires instruments specifically designed to pay off when volatility spikes and prices collapse. Short positions, put options, credit default swaps, VIX calls. These are insurance contracts that explode in value when the market implodes. Executed together, these three trades create perfect positioning. Trade 1 protects you from losses. Trade 2 protects you from the Fed's response to the crisis. Trade 3 generates the capital to deploy when prices are destroyed and you're buying at the bottom. This isn't theory. This is documented history, repeating in real time. And right now, in November 2025, all three trades are being actively positioned. Trade 1 is the recognition signal. It's when the smartest money in the world looks at valuations, does the math, and concludes that something has to break. Not maybe, has to. And when they reach that conclusion, they take action before anyone else sees the danger. The action is conversion to cash, systematically moving out of positions and building defensive reserves. This typically happens 12 to 18 months before the crash actually arrives. It's the earliest warning sign that sophisticated investors understand the setup has become dangerous. Let's look at 1929 first. Joseph Kennedy wasn't some conservative banker. He was an aggressive stock speculator, one of the most ruthless ones in the Roaring '20s. He made his fortune running stock pools, coordinated buying schemes where insiders would accumulate positions quietly, then all buy simultaneously to drive prices up. Once the price had risen enough, the insiders would dump their shares at the inflated prices, profiting from their own manipulation, while ordinary people bought at the peak. Kennedy had done this repeatedly and accumulated serious wealth. But by the middle of 1929, something had shifted in his thinking. The market had tripled in 5 years. Everyone was buying. The entire conversation was about which stocks would make you rich fastest. Stock tips were being passed around by shoeshine boys and taxi drivers, people with zero knowledge of finance. But Kennedy understood what this meant. When leverage is everywhere and everyone is fully invested, the structure becomes fragile. He grasped something that most people miss. When every buyer has already bought, when you've exhausted your universe of new money entering the market, you hit a wall. Prices can't keep rising because there's nobody left to buy. And if there's nobody left to buy, and prices even hiccup downward, something terrible happens. Investors who bought on margin, borrowing money to amplify their positions, suddenly face margin calls. Their brokers demand payment. They're forced to sell. That selling drives prices lower. Lower prices trigger more margin calls, more forced selling. It becomes a cascade, a death spiral. This is the mechanical trap of leverage. Kennedy saw it clearly. So beginning in summer 1929, he started systematically liquidating his stock positions. He didn't dump everything at once. That would move the market, signal his intentions, and get him poor prices. Instead, he sold steadily over several months. Reducing exposure, raising cash, converting his portfolio from equities into liquid reserves. By September, Kennedy had substantially exited. He was sitting in cash. The market peaked on September 3rd, 1929. Exactly 1 week later, the decline began. Within 7 weeks, the crash had arrived. October 24th, Black Thursday. The market fell 13% that day alone. It was just the beginning. Within weeks, it had fallen 50%. By 1932, it had fallen 89% from peak. Kennedy, sitting in cash, was untouched. Every dollar he'd preserved could eventually be deployed buying assets at pennies on the dollar. Jump to 1987. Paul Tudor Jones was running a successful hedge fund trading commodities and equities. But by mid-1987, he started running numbers on the market. The Dow Jones had gone from under 1,000 in 1982 to over 2,400 by August 1987. A 140% increase in 5 years. Price-to-earnings ratios had become stretched. Margin debt was surging through the system again, and a new phenomenon was creating instability. Program trading, where computers executed massive buy and sell orders automatically based on mathematical formulas, with nobody actually analyzing whether the trades made sense. Jones did his analysis and reached a conclusion he communicated to his investors with precision. A major crash would occur within months. Not a maybe, not a possibility, a certainty. In August and early September 1987, Jones began reducing his long stock positions. He raised cash. He positioned his fund for what he knew was coming. The market peaked on October 2nd, 1987, at 2,722. Just 17 days later, October 19th arrived. Black Monday. The Dow fell 508 points. That's 22.6% in a single trading session. The largest single-day percentage decline in history. Jones, already in cash, was positioned perfectly for the trades that would follow. Now, 2008 was more complex because multiple investors reached their crisis conclusion at different times. Michael Burry started converting to defensive positioning in 2005. His fund had been buying undervalued stocks, but when Burry dug into subprime mortgages, he realized the entire foundation of the financial system was fraudulent. Loans were being written to borrowers who couldn't possibly repay them. The whole thing would collapse. So Burry stopped investing in equities. He raised cash. He held it. John Paulson arrived at the same realization a year later in 2006. He saw the housing bubble. He understood it would destroy the banks. Rather than just raise cash defensively, Paulson launched an entire fund dedicated to shorting the mortgage market, which required raising capital specifically for that purpose. And then there was Warren Buffett, who had been building a fortress of cash since 2006. Berkshire Hathaway's cash position had grown from $40 billion to over $60 billion by 2007. When investors asked Buffett why he wasn't deploying that capital, he gave a telling answer. He couldn't find anything worth buying at current prices. Translation: valuations have become insane. Everything is overpriced. The market peaked in October 2007. By that date, Burry, Paulson, Buffett, and the other sophisticated investors were already sitting in substantial cash positions. When the financial system began collapsing in 2008, they were protected. And 2025 is where this becomes impossible to ignore. Buffett is sitting on $325 billion in cash. That number is so large it requires context. That's not just a lot of cash. That's the largest cash position in Berkshire Hathaway's entire history, both in absolute terms and as a percentage of assets. Buffett has been actively selling stocks to raise this cash. He reduced Apple, one of his highest conviction holdings, by 50%. He's been systematically selling Bank of America shares. He's not buying anything. In his 2024 shareholder letter, Buffett stated plainly that he cannot find anything attractively priced in today's market. Everyone understands what that means in Buffett language. Everything is overvalued. Get out! But it's not just Buffett making moves. Across corporate America, company insiders, the people who actually run these businesses and see the real financial numbers, are selling stock at levels not seen since 2007. Jeff Bezos has sold over $13 billion in Amazon shares during 2024 and early 2025, even as the stock hits all-time highs. Mark Zuckerberg has sold billions in Meta shares during the same period. Jamie Dimon, the CEO of JP Morgan Chase, sold stock for the first time in his entire tenure as CEO. These aren't speculative traders or hedge fund managers guessing at direction. These are company insiders who see the actual health of their businesses, their customer behavior, their cash flows, their real competitive position, and they're converting to cash. That's what Trade One looks like when it's happening in real time. The smart money is exiting. The pattern is identical to 1929, 1987, and 2008. Systematic, methodical exit 12 to 18 months before the crash arrives. Once you've raised cash and exited your equity positions, you face a new problem. You're holding currency, dollars, yen, whatever the denomination. But here's what always happens during a financial crisis. Central banks panic. They don't allow the system to cleanse itself through bankruptcy and price discovery. Instead, they print money aggressively. They expand the money supply massively, trying to prop up asset prices and prevent systemic collapse. This creates a problem for anyone sitting in cash. The quantity of money explodes. The purchasing power of each unit of currency declines. Your cash preserves you through the crash, but as the Fed starts printing, the real value of that cash gets eroded. This is where Trade 2 becomes essential. You don't just hold cash. You hold something that maintains value when fiat currencies are being debased. That something is gold. Gold has been the answer to currency devaluation for 5,000 years of recorded history. And the investors who understand Trade 1 know they need Trade 2 to complete the picture. Look at Bernard Baruch in 1929. Baruch was one of the most successful investors of the early 20th century. He'd built a fortune by recognizing bubbles early and positioning to profit from them. By 1929, Baruch understood what was coming, but his response went beyond simply raising cash. He actively converted substantial portions of his wealth into gold, physical gold. He grasped something that most investors missed even then. The initial crash would create deflation, falling prices, contracting money supply. But governments don't allow deflation to persist. They're terrified of it. So they respond with currency debasement and inflation. They'll print money to try to reinflate prices. Gold preserves purchasing power through both phases. When the crash hit and deflation arrived, gold maintained its value at the official fixed price of $20.67 per ounce. That might sound like a defeat, prices falling, but gold staying stable. But Baruch understood the second part of the cycle. In 1934, the Roosevelt administration devalued the dollar against gold. They repriced gold from $20 to $35 per ounce. Suddenly, anyone holding gold saw a 69% gain in dollar terms. Baruch's gold holdings had appreciated massively while stocks were in freefall. While ordinary investors who held equities were destroyed, Baruch's wealth grew. By the mid-1930s, he was wealthier than before the crash even started. That's trade 2 working perfectly. Fast forward to 1987. Gold played a different role because the 1987 crash was a one-day event. It was violent, a 22.6% decline in hours, but it recovered quickly. It didn't cascade into a multi-year bear market. Still, investors who had positioned in gold in 1986 and early 1987 profited. Gold was trading around $300 per ounce in early 1987. During the October crash, as investors panicked and fled to safety, gold spiked to $475. That's a 58% gain in weeks while stocks were in free fall. It proved the mechanism. When panic hits maximum intensity and people are desperate for something real and tangible, they move into gold. The price surges. Paul Tudor Jones, who had raised cash through his first trade, held gold positions alongside his cash reserves as part of his overall defensive positioning. When the crash arrived, his gold spiked in value, adding another layer to his protection. But 2008 is where trade 2 became absolutely critical. Gold was around $600 per ounce in 2007 when the sophisticated investors started positioning defensively. As the financial crisis unfolded through 2007 and 2008, as major banks failed and the Federal Reserve began printing money at unprecedented scale, gold surged. By March 2008, it had reached $1,000 per ounce. By 2009, it had climbed above $1,200. It eventually peaked at $1,900 in 2011. John Paulson, after making billions from his mortgage short positions, deployed substantial additional capital into gold. He understood the Fed's response to the crisis would require unlimited money printing. And unlimited money printing means currency devaluation. Currency devaluation means gold appreciation. Paulson's gold fund made billions on top of his mortgage short gains. The investors who had the discipline to hold gold from 2007 all the way through 2011 tripled their purchasing power. Stocks went nowhere during that period, but gold holders were getting wealthy. And now in 2025, Trade 2 is executing at a scale that's almost unprecedented. Central banks globally have been buying gold at record rates. In 2022, 2023, and 2024 combined, central banks purchased over 3,000 tons of gold. That's the highest three-year total since governments started tracking this data in 1950. China is buying aggressively. Russia is buying. India, Turkey, Poland, Singapore. Nations all over the world are accumulating gold. They're doing this for the same reason the smart money does. They see the same thing. Unsustainable U.S. government debt. A dollar that's being printed relentlessly. Currency devaluation that's inevitable. Gold is protection. And it's not just central banks. Billionaire investors are accumulating too. Ray Dalio has been vocal publicly about holding 5 to 10% of investment portfolios in gold. Stanley Druckenmiller has disclosed significant gold positions in his fund. Paul Tudor Jones has stated publicly that he owns gold as a hedge against inflation and currency debasement. Gold is currently trading near $4,500 per ounce. Record highs. Why is this happening? Because the smart money is executing trade 2 right now, in real time, at massive scale. Here's what happens next. When the crash arrives, and based on this pattern, it will arrive within the next 12 to 18 months, the Federal Reserve will respond exactly as it always does. Unlimited money printing, quantitative easing, currency inflation at levels people haven't experienced in decades. When that happens, when the dollar is being debased 20 to 30% through Fed expansion, gold will surge further. $5,000 per ounce is realistic. $6,000 is plausible. Some projections put it even higher, approaching $10,000. The investors who hold gold will preserve their purchasing power, while everyone holding dollars or dollar-denominated bonds gets destroyed. Their wealth doesn't just survive the crash, it actually appreciates through the crisis. Trade 2 is already active. Gold accumulation is happening at an institutional scale right now. Trade 3 is where the pattern becomes profitable. It's where you stop just surviving and start getting rich. This is the volatility bet, the instruments that pay when markets collapse. This trade happens 6 to 12 months before the crash, once you've already raised cash and accumulated gold. You're now going to position for the actual collapse itself, to profit from the liquidation cascade, to turn fear and panic into wealth generation. This requires specific instruments, mechanisms that gain value when volatility spikes and prices fall. Shorts, put options, credit default swaps, VIX calls, insurance contracts essentially, bets that pay off when the market implodes. Joseph Kennedy executed this in 1929 after he'd already converted to cash. Beginning in late summer and early fall, Kennedy established short positions in multiple stocks. Shorting means borrowing shares from a broker, selling them at current prices, and betting you can buy them back cheaper later. Kennedy was paying borrowing costs the entire time he held these positions, while stocks continued rising through September. He was losing money on the premium he was paying, but he understood the trade perfectly. When the crash came in October and stocks began collapsing, Kennedy covered his shorts. He bought back the shares at destroyed prices, returned them to the lender, and pocketed the difference. Estimates based on Kennedy's wealth accumulation patterns suggest he made somewhere between $15 million and $50 million from his short positions. In today's dollars, that's equivalent to several hundred million. This is Trade 3 paying off. You pay premiums while waiting. You collect massive profits when volatility explodes. The most legendary execution of Trade 3 happened in 1987 with Paul Tudor Jones. We know the details precisely because a documentary crew was actually filming him during this period, capturing one of the greatest trades ever executed in real time. After raising cash and accumulating gold, Jones took his positioning to the profit phase. He bought massive positions in put options on stock index futures. Put options give you the right to sell at a predetermined price. If you buy puts with a strike price of 2,500 on the S&P 500 when the market is trading at 2,700, and then the market crashes to 2,000, your puts are worth 500 points of profit per contract. Jones bought thousands of these contracts. He spent millions paying the premiums. Then he waited. October 19th, 1987 arrived. Black Monday. The Dow fell 508 points, a 22.6% single-day decline, the largest percentage drop in history. Jones's put options didn't just become profitable, they exploded in value. He made $100 million that single day. His entire fund was up 62% in just October. The documentary cameras captured him on the phone executing trades, generating millions in profit in real time while panic consumed the rest of the market. It's the most perfect execution of Trade 3 ever filmed because it shows the exact pattern. You pay premium while waiting for the catalyst. The catalyst arrives. Your instruments become worth thousands of times what you paid. By 2008, the instruments had evolved. Michael Burry couldn't short subprime mortgages directly. The mechanics didn't exist in 2005 and 2006 when he was positioning. So he worked with Goldman Sachs and other banks to create credit default swaps on mortgage-backed securities. These are insurance contracts. Burry agreed to pay a premium, roughly 2 to 4% per year on the notional value he was insuring. If he was insuring $100 million in mortgage bonds, he paid $2 to $4 million annually. If the bonds didn't default, Burry lost the premium. If they defaulted, he he collected the full insured amount. From 2005 through 2007, Burry paid these premiums. His investors were furious. They thought he'd completely lost his mind. The housing market kept rising. He was losing money every month. The psychological pressure was immense. But Burry understood Trade 3. In 2007, subprime defaults started accelerating. By early 2008, the bonds Burry had insured began going into default. The credit default swaps started paying out. Contracts that Burry had bought for a few million in premiums were now paying out hundreds of millions. When the bonds went to zero, they paid out their full notional value. Burry's fund made over $700 million. John Paulson executed the identical trade on a much larger scale. He bought tens of billions in credit default swaps on mortgage securities. When the housing market collapsed, Paulson collected an unimaginable payout, $15 billion across his various funds, with $20 billion in total gains. He personally earned $4 billion. This is Trade 3 at absolute maximum scale. Years of premium payments. Then the single largest payout in hedge fund history. And right now, in 2025, Trade 3 is being positioned actively. Credit default swaps on commercial mortgage-backed securities have spiked in price. The cost to insure against defaults on commercial real estate loans has increased 300 to 500% since 2021. Why? Because institutional investors believe commercial real estate is going to collapse. Office buildings sit 40 to 50% vacant because of permanent remote work. The economics no longer function. Mortgages that were written at 3% interest rates are maturing and must be refinanced at 8%. The math is impossible. Defaults are inevitable. Investors buying these credit default swaps now are paying elevated premiums. But when defaults cascade through 2025 and 2026, these swaps will pay out massively, just like the subprime swaps paid out in 2008. Put options on major stock indices are showing unusual institutional activity. Large institutional buyers are purchasing puts on the S&P 500 and NASDAQ, with expiration dates in late 2025 and 2026. These are bets that markets will crash during that window. The put-call ratio, which measures the volume of puts being bought relative to calls, has elevated above 1. More protective puts being purchased than bullish calls. This indicates institutional hedging. Institutions are buying insurance. The VIX is seeing elevated call option purchases, bets that volatility will explode. Billionaire has discussed publicly that he's considering hedges similar to his March 2020 positioning, when he turned $27 million into $2.6 billion in weeks. He hasn't disclosed exact positions, but he's signaling that Trade 3 is active. The pattern across 1929, 1987, 2008, and now 2025 is undeniable. The same 3 trades happen in sequence every single time. Here's why they work. Every major crash follows an identical mechanical sequence. It starts with a bubble. Asset prices become disconnected from fundamentals. Then comes euphoria. Everyone believes prices will keep rising forever. Valuations don't matter. Then comes maximum leverage. Everyone borrows heavily to amplify gains. Then comes a trigger. A small decline. Nothing dramatic initially. But that trigger starts stage 5. Forced liquidation. Leveraged investors face margin calls. They're forced to sell. That selling drives prices lower. Lower prices mean more margin calls, more forced selling. A death spiral. Prices fall not because fundamentals got worse, but because of mechanical forced selling. Then comes panic. Fear overwrites analysis. Liquidity evaporates. The VIX spikes to 50, 60, 70. Markets fall 20, 30, 40% in weeks. This is the crash. This is when the 3 trades pay off. Cash means you're not being liquidated. You're protected. Gold means you're not holding depreciating dollars, while the Fed prints unlimited money. You're preserving wealth. Volatility instruments mean you're profiting from the crash itself. Your puts and swaps explode in value. Right now, in late 2025, all three trades are happening simultaneously. Trade 1 is substantially complete. Buffett's $325 billion. Insider selling at 2007 levels. The smart money is out. Trade 2 is accelerating. Central banks buying 3,000 tons of gold annually. Gold at $4,500, record highs. The wealth preservation trade is active. Trade 3 is being established. CDS on commercial real estate spiking. Institutions buying puts. VIX call activity increasing. The pattern says we're 12 to 18 months before the crash. That window closes late 2025 or early 2026. What should you do? Most people can't execute this perfectly. You don't have hundreds of millions in capital or access to institutional credit default swaps. But simplified versions work. If you're 60 to 70% invested in stocks, reduce to 40%. Hold the difference in cash or short-term treasury bills. You'll pay an opportunity cost if markets keep rising, but when the crash arrives, that 30% becomes dry powder for deploying at the bottom. Buy 5 to 10% of your portfolio in physical gold or gold ETFs, not mining stocks. Actual gold. When the crash comes and the Fed prints unlimited money, gold will surge. Buy put options on SPY, the S&P 500 ETF. It's straightforward. Buy puts expiring 6 to 12 months out with strike prices 10 to 20% below current levels. You'll pay 1 to 3% of your portfolio value. If markets crash, those puts return 5 to 10 times your cost. If they don't crash, you lose the premium. That's insurance. But the psychological piece matters most. Prepare a list of quality companies you'd want to own. Apple, Microsoft, Visa, Johnson & Johnson. Companies with strong balance sheets and products people will always need. When these companies trade at 50% discounts during maximum panic, buy aggressively with the cash you protected, with the purchasing power you preserved in gold, with the profits you made from puts. After the three trades pay off, after you've protected capital and profited from the crash, comes the implicit fourth trade. You deploy everything at maximum fear. Kennedy did this after 1929. Buffett did this in 2008, investing $5 billion in Goldman Sachs at the absolute bottom. Ammon did this in March 2020, using his $2.6 billion payout to buy stocks at crashed prices. The fourth trade, buying at the bottom, creates generational wealth, but you can only execute it if you successfully executed trades 1, 2, and 3 first. Based on historical patterns, the crash window is late 2025 or early 2026. The bottom arrives mid to late 2026 when unemployment hits 9 to 10%, when the S&P falls to 3,500, when Bitcoin crashes to $20,000, when gold surges to $5,000 or higher. That's when you deploy. Then hold for 5 to 10 years while markets recover. Your positions triple or quadruple. Here's the bottom line. The three trades aren't secret. They're documented history. They've worked in 1929, 1987, and 2008. They're being executed right now in 2025 by the smartest investors alive. Warren Buffett's $325 billion in cash. Central banks accumulating 3,000 tons of gold annually. Hedge funds buying credit default swaps and puts. The pattern is playing out in real time. You can recognize it and position accordingly, or you can ignore it and hold through the crash, losing 30 to 50% like most people do. The choice is yours. The three trades have been made. The pattern is repeating. The crash is coming. Position yourself while you still can.